Good morning, good afternoon, and good evening to our followers, listeners, and readers from all around the world. My name is Dipesh Patel, editor at Trade Finance Global and host of the podcast Trade Finance Talks. Welcome to this TFG live Tradecast in partnership with Finastra. Hello and welcome also to our webinar participants and to those joining us live from LinkedIn, Facebook, and YouTube. I'll shortly be joined by global trade experts from MasterCard, JP Morgan, IFC, a sister organization of the World Bank, and Finastra. Now, the COVID-19 pandemic has severely impacted livelihoods and jobs all around the world, shutting down entire sectors of the economy over the past 18 months. The public health crisis has created supply and demand shock to supply chains all around the world. Today, we're analyzing the impact of recent events on new behaviors, purchasing trends, and trade, as well as the focus on building back recovery and creating sustainable jobs. Be that through public-private partnerships to mobilize finance, creating transparency through marketplaces and B2B platforms, or building resilient supply chains. How do we build back a stronger economy, which is more inclusive, resilient, and sustainable? Today, we'll be covering three themes: access to finance, particularly those in MSMEs and emerging and developing economies. How can technology accelerate the digitalization of trade and supply chain finance? And how can partnerships also help build a more inclusive trade ecosystem? I now invite my panel onto this virtual stage. If you can turn on your microphones and cameras. So we have Brian Edmondson, Global Head of Trade Sales and Transaction Banking at Finastra; Susan Starnes, the Global Lead and Trade and Commodity Finance Strategist, Sector Economics and Development Impact Department at the IFC; Natasha Condon, Global Head of Core Trade at JP Morgan; and Claire Thompson, Executive Vice President for Global Trade Enterprise Partnerships at MasterCard. Thank you very much for joining us. So to start off with, I'm going to do a quick elevator pitch. So in no more than 30 seconds or so, can you explain to our audience who you are, where you're from, and what you do? Brian, over to you. Oh, I think you're on mute, Brian.
Can you hear me now?
Yeah.
That's good. We enjoy challenges, Dipesh. Brian Edmondson, I'm the Global Head of Trade and Working Capital Finance at Finastra. We supply solutions for banks on working capital finance, trade finance, and supply chain. We have a wide range of banks, from some pretty big ones to some, if I can put it, smaller banks. In over 80 countries. We have over 200 banks that we provide services to. So that gives us a good framework to understand what's happening in the industry, to look after our customer base and keep them abreast of times.
Thank you. And Susan, over to you.
Yes, I'm Susan Starnes with the IFC, and we work very closely with IFC's Trade Finance Unit, a unit that, by the way, we're very proud to say has booked over $18 billion in trade support since the beginning of the pandemic. And our role, my unit's role, is to make sure that we gather and synthesize research, data, information, and translate that intelligence into both market insight for the broader public, like those on the call, but also to help the IFC improve its efforts and get more efficient, more effective at delivering impact across emerging market countries.
Thanks, Susan. And we'll go into a lot more detail about that later on in this Tradecast. Natasha, over to you.
Sure, and good morning, good afternoon, everyone. Natasha Condon. I'm not nearly as exciting in my job description as Susan, but I'm a trade finance banker with JP Morgan. I'm based in London. I run the global core trade product suite from here, and JPM Global Trade includes anything from a highly digital supply chain finance type solution, which is designed around ESG objectives, global trade, right through to risk mitigation solutions for some countries that really need it right now in the traditional trade space. And in that capacity, I know Susan's trade finance unit at the IFC very well.
Thanks, Natasha. And last but not least, Claire Thompson.
Thanks, Savesh. Hi, Claire Thompson. I lead global trade in our enterprise partnerships group here at MasterCard. So managing our B2B partnerships, which we're proud to say, we partner with all panelists and beyond. And really it's about enabling a more digital, inclusive economy for companies who want to trade cross-border.
Thank you very much. And once again, welcome to our attendees and panelists, and feel free to ask us any questions using the hashtag Trade Finance Talks. We'll be able to answer your questions. You can comment on either on Zoom here or on LinkedIn, YouTube or Facebook, and we'll endeavor to get back to you. So let's get started. And Susan, I know you're going to present some findings and some slides a little bit later on, but can you start with giving a bit of a high level overview of the impact of the COVID fallout when it comes to access to trade and supply chain finance?
Certainly. So I'd like to step back and think about pre-crisis. Hope we all remember that time. The global trade finance gap was estimated to be about $1.5 trillion. By mid-2020, just at the ramp up of the crisis, estimates started to come in indicating that the gap had expanded a great deal, more than doubled potentially. So for trade finance, it's interesting to compare global dynamics versus individual markets, especially emerging markets in lower income countries. The demand and supply really of trade finance. So at the IFC, we recently completed an annual survey of emerging market trade finance banks, over 150 banks across over 60 developing countries. I'm a vessel of emerging market bank voices today. Their insight can provide quite an overview. So we hear and see availability of liquidity picking up and being available from some views at this point. But our collective bank clients tell us a more complex story with both unfunded and funded trade finance. So globally in 2021, 46% of our emerging market client banks indicated increased demand year on year for unfunded, while only 42% said their capacity increased to meet that demand. There's still a frequency gap here, but it's largely in line with sort of the global chatter and our collection of markets. But region by region, the story changes. So for example, in sub-Saharan Africa, demand increased 60% year on year for unfunded from 2020 to 2021, with only 45% of banks, only 45% of banks saying their capacity was increasing to meet this. For funded, 44% of banks globally note increased demand. 38% note increased capacity to meet that demand. So again, a 6 percentage point gap. Again, with some regions showing much larger percentage point frequency gaps, some with capacity frequency increases, only half of demand frequency increases. And then again, as we all saw at the beginning of the crisis, we saw a trade slump. And in some cases, obviously demand for unfunded trade finance slump as well. And what we can say is that in some areas, that troubling decrease in demand for trade finance lingers. So it's showing that COVID is still very much in play in several of these markets. Deep, I turn it back to you.
Thanks, Susan, and a really good overview there on and really an analytical view on the impacts there. Natasha, how does the current shock compare to the global financial crisis of 2008?
I mean, I think in some ways it's quite similar in the sense of, you look back on 2008, it looked like it was a liquidity crunch, and that's what we were all worried about. And then it very swiftly became clear that the effect of that was echoing down the supply chain, and the guys who were suffering were not the big corporates with deep pockets who could weather the crisis and had enough, liquidity to get through. It was the smaller suppliers. It was the MSMEs who were further down that supply chain. And I think that was quite a learning experience for a lot of big corporates. There were some horror stories that people who are old like me and remember this kind of thing will remember, where big corporates discovered that, at the end of the day, your supply chain is only as good as its weakest link. And if a small company went out and that company happened to make the widgets that were vital for your production line, that was the end of your production line. You had to stop. So I think, and back in 2008, I think that came as a real shock to a lot of companies. This time around, I think it's very striking to see that lesson has been learned. The response was very quick in my experience. It was impressive. A lot of big corporates really kind of, got up and got moving to make sure that they were supporting their supply chains. And, I'm not just talking specifically about supply chain finance here. I'm talking about all forms of trade finance. It also obviously helped that a lot of the multilateral agencies got moving pretty quickly as well to provide a level of support that perhaps wasn't there in 2008 also. But I think to me, the real striking difference is the attitude of the corporates. That this time round, corporates saddled up very quickly to protect their supply chains, and they're very clear that it's the small companies and the weakest links that need that kind of protection.
Thanks, Natasha. So let's go on to our first point, and I guess I bring back your point around every supplier in that wider supply chain, and I think it's a really good time now to talk about access to finance and financial inclusion. And Claire, perhaps I'll start with you. There's no doubt that some of the hardest hit businesses from the pandemic have been female-owned and minority-owned businesses, particularly in emerging and developing markets. How can the trade industry support financial inclusion to those hardest hit?
I absolutely agree with you, Dipesh, and I'm sure the rest of the panelists have seen the same. Obviously, when this started, 18 months ago, 20 months ago, I stopped counting. I just say 2 years by now. There was a lot of financial confidence. Confidence was lost. Initially there was a little bit of paralysis about what to do next. And the practical situations were, we were in a kind of a lockdown situation in many of these countries, whether that's lockdown from supply chains mobilizing, the ports were getting congested, and whether that's physical lockdown of being literally locked down in our homes, right? So women have always lagged in terms of the financing availability they've got, right? Whether through all different forms of financial institutions. And so that just kind of compounded the situation. Women, as we traditionally do, have been juggling many things, right? Just really practical things, right? You can't rely on the extended family, to continue managing your business. The access to childcare, we were juggling, as men and women are all doing, we're juggling everything from their home. So that really compounded the situation, and I would say across emerging markets, but also in industrialized nations. And so the key is that the time to act, and as Natasha said, we did see, I would say, compared to the financial crisis, we did see action a lot sooner than we did, 10, 12 years ago. But there's still a long way to go. A couple of things that I think were impactful that we see across the board were really about kind of making sure that you set yourselves goals around kind of continuing to support inclusive support. So at MasterCard, we'd set ourselves a goal 5 years ago to increase 500 million companies and individuals into the digital economy. Given what was going on at COVID, we decided in the middle of COVID to reset those goals, to extend that 500 million to 1 billion. Included in that is 50 million small businesses, of which 25 million are women owned. And the key is just like, we're not doing that alone, right? We're making ourselves accountable. So the other piece of this is the power of partnerships, right? So working with the banks, working with the development banks, working with the technology companies like Finastra is enabling data, finance, and technology to come together, right? And we did some work we've just announced with IFC and Coca-Cola to support micro retailers and the wholesale distribution program out in Indonesia. And so I think that just evidenced the power of partnerships and coming together at a time like this, which we continue to see.
Thanks, Claire. So I guess we'll go into a bit more detail and talk about the actual supply chain finance operations, and perhaps Natasha's JP Morgan view would be really good here. Natasha, how's supply chain finance evolving to meet some of the needs of all organizations of the value chain, to your earlier point?
Sure. So, I mean, starting from first principles, right? Supply chain finance as it is intended to work, and I'm talking obviously about the solution where a large buyer allows for a financing solution to allow their typically smaller suppliers to receive some earlier payment, earlier funding than they otherwise would with the help of a bank or some other party in between. That solution at its best and the way it should be designed has always been intended for the benefit of the supplier. The supplier gets paid earlier than they otherwise would have done. They get a liquidity benefit. They get often a working capital benefit if that structure is set up correctly. And so you're taking advantage of the arbitrage of one big anchor corporate who's the buyer, who typically has a great credit rating, can borrow at really competitive pricing, and has just more firepower with the banks than a typical small supplier. So as a solution, it's absolutely designed to support suppliers, and the benefit to those suppliers tends to be greater the smaller those suppliers are, because their own access to liquidity on their own bank lines is typically more limited, and therefore being able to use a big corporate customers' lines is a proportionately bigger advantage. So it's always been a solution that lends itself very nicely to supporting a supply chain, to supporting small companies. What I think has really changed about it now in recent years, and particularly exacerbated by COVID, is two things. One of them is, you will not be amazed to hear anyone say this, is the digital revolution, right? So nowadays with technology, you can do all kinds of things that you couldn't do before. You can offer financing solutions to smaller companies where it used to be very, very hard to onboard them to this kind of solution. And that kind of sort of digital partnership, JP Morgan works with a fintech called Taulia, and some of the capabilities that they bring to the table allow for the onboarding of, very much smaller suppliers perhaps than would have been able to access that kind of solution some years ago. And so then it becomes not just a financial benefit between a mid or a small size corporate and a large one, but a financial inclusion tool that is actually pushing financing out to companies that would not have been able to access it before. And that, I think, is very exciting and ties into kind of some of the stuff that Claire was talking about just now. The other development that I've seen on the supply chain finance side, which also ties in very tightly to what Claire was talking about just now, is that digital has allowed corporates to kind of target that kind of benefit much more tightly than they used to be able to, which means that they can tie the financing to things like ESG goals. So if what they want to do is to support, for example, specifically suppliers who are minority owned, women owned, disadvantaged in some way, nowadays you can do that, right? You can measure which ones of those suppliers you have. You can feed that back into the financing program. In the same way, if you have environmental goals, I'll just give you an example, the deal which we can talk about publicly with Bridgestone, where Bridgestone set up a structure with JP Morgan and Taulia, where they have a third-party environmental auditor that checks the sustainability status of the suppliers. And if that auditor, EcoVadis, has evidence that those suppliers are improving their environmental performance, that comes back through an API into the Taulia front end, and they get a financial incentive through the supply chain finance program. So you're actually helping to mitigate the costs of going green for these small companies that otherwise would really struggle with it. So it's already part of the digital revolution. It's just that the way people are starting to use those digital capabilities is really exciting. And so you can do stuff with supply chain finance that you could not possibly have done as much as 3 years ago.
Thanks, Natasha, and some really great examples of adapting your products to your corporates and of course their suppliers. But no disrespect, JP Morgan is a very large bank with lots of kind of capabilities. And a question for Brian, how can we democratize the industry to ensure some of those smaller banks get access to supply chain finance and other types of financing?
Well, Natasha's hit on one of the key capabilities, which is technology. So we talk about digitization, but really it's the use of many types of technology. So that's number one. The second area that is the regulatory area. I think the getting clarity about, certainly on supply chain finance, what it means and how to treat it. I think the industry needs to help there, and finally with collaboration. But if I can go back to technology, certainly for the smaller banks, I think technology has been an area of fear for them. Whenever they see a new technology or they want to implement something, they see this as a relatively large project. They see the fact that they need to upskill on the technology, not necessarily the application of the technology, but the technology, how to support it, how to run it, how to work with third parties to understand that technology and manage it. And I think the industry is changing. We and other organizations now provide that technology as a service, as a subscription service. So they don't have to worry about what artificial intelligence is or machine learning is. They just get the benefits of the application of that technology to their business. And I think that's going to be a key parameter going forward, is educating maybe the smaller banks that it's not really the technology that they need to look at, it's the application of that technology, and to view them as services that they can use in their business going forward. On the regulatory side, I think there's we're seeing it now, and I'm sure the bankers and the other panelists will talk about this, but there was been some conversation around how to treat supply chain finance internally, how to book it, how to view it, how to manage it. And I think for the smaller banks looking and reading about this, there was some reticence maybe to embark on supply chain finance programs because of that lack of clarity of how to treat it. But the third area really, I think, is collaboration. I think for the smaller banks, it's about collaborating with other organizations, maybe some of the bigger banks, to provide a true end-to-end supply chain finance program, working together, where they can fill gaps that maybe the larger banks can't reach into. They understand their local customers very well. They are their customers after all. So I think the industry working together in a collaborative way will certainly help the smaller banks to be more inclusive in terms of who they work with, but also to be part of the wider supply chain finance solution.
Thanks very much, Brian. And now I'm going to go on to Susan, and actually a question from Mark Christian Villis on LinkedIn. And Mark comments that supply and demand has changed, resulting to change in fiscal and monetary policy. How do we get through this, and how can global trade help kind of alleviate some of the things that we've seen? And also, Susan, if you can talk through the recent IFC survey results that you guys did on correspondent banks when it comes to access to finance in emerging and developing countries, that would be great. If I can get the guys to pop the slides onto the screen.
Sure. And first to the question, our audience member is completely correct. You know, what we've seen as we've watched this carefully over the last almost 2 years, I think, as Claire mentioned, you know, in the beginning, as the crisis unfolded, and not just private sector players, but also the government level of intervention was quite impressive and quite rapid, shows some learning from the global financial crisis. But what we're also finding is that that these sort of federal coffers are wearing thin, because they've had to continue to support with sort of fiscal stimulus or just fiscal maintenance what's going on in the crisis at this time and trying to keep their economies alive, not thriving or growing, but just alive. And so what we're finding is that the more money that's spent to help maintain activity during the crisis, the less money there may be to accelerate out of that crisis once it does abate. And that's when, our sense is that there's a huge role for multilaterals, but beyond that, there's a huge role for the extended private sector to come in and help fund this eventual recovery and to help to expedite that. We're all of us, even on this call, and those beyond us, have been involved in helping to try to break the falls. We call it raising the floor for some of these economies in crisis. But our job isn't done at that point. There's the recovery has a great opportunity actually to shift the development trajectories of many of the markets that have been struggling or challenged for some time. And the only way that's going to be realized, that potential will be realized, is with full engagement of players, cross-border players, effectively in trade finance and supply chain finance across the world. But moving quickly to my slides, Deepesh, I'm mindful of the time, so I probably will not go through all of them. For the last decade or so, IFC has conducted an annual survey of its trade finance emerging market client banks. We've done 2 during COVID, one the first half of 2020, right in the thick of things, as well as one covering the first 7 months of 2021. We call that hot off the press. You see some other publications there, including a distinct trade and trade finance trilogy. This survey covered, as you see, 151 issuing banks across 64 developing market countries. I wanted to note that this covered all regions, and it's roughly half and half on emerging market size. So between the lowest income emerging markets, I've seen some participants in some of these countries on the call today, and some of the larger or middle-sized emerging markets as well. So moving to the next slide. Yes, and this is where I'll spend my time. This is the most important slide of the collective piece. By the way, this has not yet been published. So everyone on the call the Trade Finance Global audience is getting a bit of an early glimpse of what's to come. So we give Deepesh the rights to the first public presentation. But one of the most important challenges in COVID, what's important to know is that they persist. So we're all optimistic and hopeful. As a matter of fact, all of our banks are that the world will return to better than normal at some point, but we are not there yet. And so I'd like to pause. The most important challenge is reflected in that second headline number, or the first headline number on the top left. And it's actually inspiring for us to see how banks all over the world, including those on this call, have put their people first. And that's a mark of true leadership. So over 84% of our emerging market banks mentioned concern for staff's well-being and customers' well-being in 2020, right from the start of the crisis. That actually motivated the expedited digital shift in a way. This has not changed in 2021. Those concerns are still valid. Also, at the bottom headline number there, that 95%, those are the percentage of emerging market trade finance banks that noted that customers were negatively affected by COVID. No surprise there. Only a slight decrease from 2020's 98%. But what we do see is that businesses are facing pressure on all fronts, including those supply chain participants. As demonstrated by the sheer number of issues identified, and you see those listed or summarized on the bars to the right. The top set of bars provides details on financial challenges that customers faced. 93% of our banks mentioned that customers were in crisis versus only 91% in 2020. And while we do see some changes among those improving in 2021, that's the darker blue bar. But if you look very closely at those values circled in red, the fact is that they're all quite high. We don't see, this is a triple, quadruple the percentages that we see in normal years. And so then Also, take a look at that second bullet point in the left blue shaded box. This is the most important point of the presentation in terms of astronomical shifts in market data. So 65% of banks reported liquidity constraints or limitations in 2021. That's versus 33% in 2020, which at the time, 33% was quite significant. And then if we bounce back to the bottom right with the operational challenges on the chart below, 91% of our banks indicated at least one customer had operational challenges, no surprise there, but the figure is still higher than 2020. Again, still exceptionally high. And if you look at the list of operational challenges that are faced by those that are actively in the middle of these supply chains, we see value chain disruptions, export demand issues, export production issues, securing raw materials through imports. These don't even show up. They don't make the list in normal times. And so this tells us that, that COVID, while we do see some bright light, we see some export demand starting to emerge with that shift from 71% mentioning problems to 62%. What we do see is that that's a fledgling sign for a recovery, and it gives us hope, but we are not out of the woods yet. I don't think we're going to have time to go through the rest of the slides, but I do want to note that correspondent banking stress, not on the slide, is continuing to increase. And we see that in several places on our survey. We define correspondent banking stress as not the number of a simple line count, but everything, all of the activity that goes within that line, with line limits, with tenor limits, with cost of financing, with throughput speed from request to approval, and several other pieces, the availability or the compression of products being covered across borders. And we did see that increase substantially over the last 2 years. That's no surprise. Banks reporting some form of CBR stress went from 10% 10 years ago to 39% in 2020, and then up to 81% in 2021, including a large portion of the banks that have been stress-free in 2020. Most of them, again, when we look at that through a liquidity lens, which is what you see on this slide, is that even asking outside of the tell us about your CBR stress kind of questions, what we're seeing is pressure on those, when I say CBR, I mean correspondent banking relationships. And what we see is sort of the top drivers of liquidity challenges are related to those incredibly important cross-border lines. So financing cost, a desire for longer tenors, and a desire for increased line limits. Now, that's not a crazy set of requests. Any banker worth his salt is going to be asking for these things. But what we do see is the frequency of these mentions and these asks have risen exponentially. So I'm going to stop there. I don't want to overstay my presentation welcome, and I'll just turn it back to Deepesh.
Thank you very much. And I think we can really see a huge increase in that correspondent banking stress, increase in cost of borrowing, and obviously that has a huge impact on MSMEs in emerging and developing markets. Perhaps technology can alleviate some of these pain points. And perhaps, Susan, I will ask you one more question as we move on to this technology section of the Tradecast. Can data and big data play a role in terms of MSME risk scoring? And perhaps could there be a new, better role for credit ratings agencies within this?
The answer is yes, yes, yes. Everyone on the call is aware of that, and I agrees. On a global scale, we've mentioned the sort of plight of the MSME, but I'd like to talk about the impact, and I'd like to celebrate them for a brief second here. On a global scale, MSMEs engage in trillions of transactions. The world is teeming with goods and services changing hands because of MSMEs. So they're so small in individual isolation, but they have such a big impact with what goes on in the world. So we often we often think about how can we help them and how can we get them access, because the access to finance gap is in the trillions. But in reality, we also want to celebrate them, and we're helping them because of the role that they play globally in both economies and other 200 million MSMEs over the world. Those are people taking risks, working hard to create better lives for their families and improve their communities through the services and goods that they provide. Sort of like all of us, they're part of us in that sense. So absolutely a systematic process for collecting, reviewing, understanding that data that tells the story of these efforts, both the successes and the failures. It's a chance to open the doors both deep and wide for a segment. For bankers on the call, our view is because MSMEs, it's such a large extent, lack access to finance, particularly during crisis times. This offers a great opportunity for growth in local markets, because that is the segment just waiting for attention and care. But we do see that $5 trillion gap in emerging markets alone. The main driver was what I call murky risk. So financial institutions statistically unsure of the risk they were taking with each individual SME. That's impossible to price if it's statistically unsure. And also real sector B2B buyers uncertain of those operational risks. So the confluence of increasingly available data, of course, if absorbed and assessed in a confidential, structured, consistent way, that's exactly what's needed. It's the thing that will open the door for this whole new segment, which creates opportunities across the board. And again, Claire mentioned this great example of how to get involved, our partnership with MasterCard, Coca-Cola, and Friends as well. That's a way of not just getting finance to these micro enterprises in Indonesia, but it's also a way of connecting them. It's brilliant, Claire and MasterCard, of connecting them into sort of a system that can start to record their credit history. And for the first time, when bankers look at there as a potential for a loan, they're going to know a little bit more about those SMEs and how they're doing. So absolutely, credit reference agencies, they can innovate to contribute to this new slice of data collection and maintenance and analysis. They can innovate to partner with those who are already artificial intelligence masters. But that requires the construction of multi-directional trust. And we've already mentioned the cost of digitization. A lot of times, some of these agencies just don't have the budget or don't think they have the budget to connect. And so it's finding a way to connect them, because their role in most of these markets, they have a great deal to contribute.
Thanks, Susan. And I think the idea of that murky risk is a very good analogy there, and I'm probably going to steal that off you. $5 trillion trade finance gap, and I think to many of the participants who are asking questions, Inderjit Singh as an example, in talking about the digitization capabilities and supporting deep tier suppliers. Claire, what role can data play in advancing access to trade finance?
I think it's absolutely critical, right, as Susan pointed out. And I think there are the traditional ways where we've used data, right, and we've built up, credit agencies, and clearly they play a very pivotal role to continue to do that. And the trust then that they create around kind of extending financing by having those credentials. I think in terms of what we've learned and what we've seen, that isn't always necessarily available for these segments of the market that we're trying to address, right? So we need to find more dynamic ways to get at the data, right, and create a digital history for the micro SMEs and the SMEs. And Natasha and I were talking about this in our briefings. It's like, what can we do around open banking, right, and spearheading that into these sectors, right? Because the biggest asset, apart from their people that a company has, is their data, right? So there's a real opportunity through open banking to, explore and exploit the use of a company's own data and get, access to their performance history in terms of the delivery of goods, the quality of goods, and also their payment history. So you can create a dynamic, real-time, relevant credit passport for companies. So I think we need to explore new ways. We've obviously got the regulation has opened up in Europe. We're seeing a lot more happening in US and Australia and Latin American open banking. So for us as MasterCard, it's really kind of thinking how we can play that infrastructure role of that standardization and using technology to get at the data, working with obviously the banks, development banks, and the technology companies.
Thanks, Claire. And a very interesting questions come through from Ian Laverty, which I'm going to ask you, or feel free, anyone else on the panel to answer this. How do we solve the issues around the cost of data? So banks need good data to provide finance, but data in emerging markets is very limited. This means data providers charge more to provide it, making it prohibitively expensive in the markets that need it the most. What can be done, and how do we work with data providers to up their game?
I'll kick off on that. I think it's clearly it's getting access to the data using technology, right? Using the technology, using the partnerships, and thinking about the ways we can do it differently. So I think it's just about kind of working with different groups in the ecosystem. And then, not necessarily solving for solutions differently, country by country, bank by bank, is creating that standardization. But I honestly believe it's down to actually digitally enabling those companies to get access to the data and creating, a standardization around that. Then we'll get the cost benefits, because we'll be able to replicate something at scale.
Thanks. Brian, do you have anything to add there? And also, would you be able to talk about, I guess, the use cases for other new and developing technologies such as AI and ML with respect to credit decision making?
Yeah, just to follow on from Claire's point, she's absolutely right. I think it's up to all of us to work towards standardization of data. That's the biggest challenge of even with things such as the name of an organization, maybe operating in different countries, it might have a different name, et cetera. So initiatives such as the GIEF and others, I think, are going in the right direction. And the ICC is pushing this very hard with the regulators as well to try and come up with a standardization way of looking at data. It's very, very, very key. In terms of AI and machine learning, it's been a technology that's been talked about for a long time, but I think its time has come now. I think we see the impact on traditional trade finance is becoming quite significant. If we look at the areas of cost with for banks doing business in trade finance, it's compliance checking, it's document checking, hugely manual tasks, looking at paper, looking through paper, and this is where machine learning and AI are really having an impact. Certainly the bigger banks have been using it for a while, and as we have with some of our bigger customers, and the impact has been tremendous in terms of cost reduction, up to 80% in some of those areas, and probably as important is the reduction in risk. So with using AI and these other technologies, you get a much better coverage of risk. I'm not going to ask any of the panelists to comment on what I'm about to say, but I don't know of a bank that does manual compliance checking that does 100% compliance checking. It's just an impossible task for a bank to do. Using the newer technologies, you're getting to sort of 90% of the compliance checking. And that's the fundamental level. And I think you see the impact that's having. And coming back to the democratization, that's now available, I think, for the smaller banks to have as a service. So previously, coming back to what I was saying before, the bigger banks would invest in that technology, apply that technology, and usually at some cost and some pain. Now it's becoming more of a service. So I think that's very important. and that'll help reduce the costs for the smaller banks. But if we look at the higher level, and we've touched on this already, and that's about data. Having data lakes, huge data lakes of this data in different formats, different definitions, is very costly to assimilate what's actually happening. And I think the application of machine learning to that data can recognize changes in behavior, changes in trends that will get banks and non-banks that are increasingly involved in trade finance, get them ahead of the curve rather than waiting for the shock. They can now use artificial intelligence to look at the data, changes in behavior, and be ahead of the game. And we see some of the banks using this to predict about what's to happen rather than wait for it to happen.
Thanks, Brian. And I think I'd like to extend a welcome to some of our listeners joining us literally from all around the world. We've got people from Malaysia, Amsterdam, Ethiopia, Nigeria, Angola, Burkina Faso, Dubai, Turkey. So welcome everyone to this Tradecast. And actually, Natasha, I think that leads on to my next question, because is this causing this kind of tech investment that we see? Do you think that's causing a bit of polarization between some of the large global banks and some of the smaller local banks in emerging and developing economies, particularly those correspondent banks and those that perhaps can't afford the digital transformation and various technologies to help them?
I definitely think it's having a bit of that effect. At the end of the day, the development of these technologies takes a lot of investment, right? So, if you want to use machine learning on a set of unstructured trade documents that I'm sure many people on the line know what that can look like, document pack that's been presented under an LC where something's been faxed and something's been stamped on, and somebody scribbled on it and tested their pen out on it. And then you expect that to go through an OCR process to be converted to digital data. And then you want a machine learning algorithm to do something intelligent with that will also satisfy the compliance requirements of a modern bank, which are pretty fearsome. You are asking a lot, right? That takes a lot of investment. And so I really agree with Brian that there's some really interesting partnerships popping up between kind of technology specialist companies and sort of big banks with big pockets and technology budgets that can kind of invest in some of this stuff. What that does, if you don't do anything smart with it, of course, is it leaves those without the deep pockets behind, which is the vast majority of trade finance banks in the world, given that, there's a big falling off once you get below about, I think, the top 10 trade finance banks in the world, and then there's thousands and thousands below it. And for those banks, the question is going to be, how can we deliver the technology to them in such a way that it does not require them to spend enormous amounts of money they don't have on inventing stuff from scratch? And that's where modern models like software as a service and subscription type services that Brian talked about get really exciting. From the JP Morgan perspective, over on the cash management side, for example, we have the Link blockchain, which has some hundreds of banks already securely exchanging data on it. And those banks are not, the big giants necessarily. Some of them are very big, some of them are not so big. But it's a network where we can share information in a democratic way, in a secure way that potentially can be used for all kinds of interesting stuff with regard to compliance data sharing and similar. And in the same way, the data standardization story makes that easier. If we're all using the same legal entity identifier to know who our counterparties are, then that saves an awful lot back and forth between banks that used to go on. So I do think, yes, absolutely, there's a polarization between big banks and small, but also, don't underestimate what those potentially smaller banks are going to do with it. We've all seen in examples of things like, consumer access to banking in places like Africa, where some of those populations just leapfrogged the developed markets and went straight from no banking to fully mobile phone-based banking at a time when everyone in Europe was still queuing up outside their bank branch. So, there's a big opportunity there, I think, for the EM banks, for example, to really jump forward in terms of their technology capability. But there's got to be providers out there who will offer it in a way that it doesn't require massive investment upfront.
Thanks very much, Natasha. And going back to Brian's point earlier, a comment from Alex Gray. Hi, Alex at LIBF. He agrees with you, Brian, regarding that reduction of risk, and says there is also the aspect of risk on the wellness of the teams handling the documents. I think that's where we really do see those biggest issues. AI potentially reduces the drudgery and the stress of potentially missing those compliance issues. Any comments there, Brian? Oh, I think you're on mute.
No, I totally agree, and as probably one of the oldest people on this panel, I think the experts that are willing to do that is a diminishing pool of resources. So there's that challenge for banks as well. I think it's the expertise is getting older.
Thanks, Brian. So let's move on and talk about partnerships. I'm conscious of time. I think we're going to run over by around 10 to 15 minutes, if that's okay with everyone, because I think this is a really exciting discussion. Let's talk about B2B marketplaces and networks and partnerships. Claire, can these help build resilience and increase choice without creating digital islands? And can I ask you to also define your opinion of what a digital island is as well?
Sure. Look, it's logical. We've certainly seen the acceleration of partnerships. I would say Natasha made the point earlier, even from the bank standpoint, the last 3 years, so even pre-COVID, no doubt that has significantly accelerated, right? Because it's had to. I think just to take a step back on partnerships, right? I mean, my role is to run partnerships, and I think partnerships are great, but you've got to be really mindful of kind of selecting your partners, right? And there are kind of ingredients, and believe me, we've had some really successful partnerships and some non-successful ones, right? And you take the learnings from that. I think you've just got to really kind of think about what's your reason to partner? Why are you here? What are you actually focusing on? What's your problem that you're solving? And really focusing on the customer, not just the fact that a great company here and a big company here, 2 big companies are partnering, so we're just going to solve all these problems because we're really 2 big companies. I think you have to really focus on why you're such a great natural fit. And actually, when you're telling people and informing the market about your partnership, focus on that why, not just it's about us partnering. So, and there's a lot of groundwork that you have to do to make sure that you're going to be a good natural fit. So for me, it's as much as kind of putting it into kind of selecting the partners and kind of, then you can ensure a much more successful experience together, right? And I think once you do get going, importantly, we all know this, but don't go for the big bang approach, right? It's about kind of taking bite-sized chunks, whether that's starting off with some pilots, moving into full commercialization, like the work we did with Susan at the IFC. We decided we'd start in Indonesia, we'd start in certain cities, and it's incrementally of how you actually execute on it as well, right? So yes, clearly the increase, there's a much more significant increase of B2B digital marketplace than there are even in consumer now. So we see that, and no doubt we're seeing that in freight as well, which has been, as we all know, such a manual kind of led industry, but given all what it's needed to actually continue and support supply chains in these really stressed times, we see an advent of, freight exchanges. We're partnering with a number of constituents across there, right? So I think it's critical about how you go about your partnerships and your reason for partnerships. It would be my advice.
Thank you very much. And a question to Natasha, and I guess hopefully you can go into a little bit more detail there. Can you talk through any real example or case studies of how technology and third-party bank to fintech partnerships have helped some of the programs you offer?
Sure, and I, if I may, I'll go back to that Bridgestone example I mentioned very briefly earlier, just because it's one that I'm allowed to talk about publicly. But that's a very nice partnership, right? So you've got, what you have there is you have one massive corporate buyer in the form of Bridgestone. You have many thousands of small suppliers who supply all kinds of different stuff in different countries around the world. You have EcoVadis, which is a third-party environmental auditor, which gives a sustainability score, and they will work based on the targets of the individual company. And obviously, I'm sure we've all, so this is sort of intuitively obvious to all of us, but different corporates have very different targets in terms of what they want to do. Do they want to drive financial inclusion with their supplier base? In this case, they wanted to drive better environmental performance. Do they want to pick out particular suppliers for particular support? So EcoVadis works on a customized basis to measure the performance of those suppliers against the environmental targets of Bridgestone, gives them a score. And you can imagine for the suppliers, there's a couple of things they have to do to meet that data requirement, right? First, they have to sign up with EcoVadis and open up their operation to give that data to the auditor. And this would be true of any form of auditor of any kind of topic, of course, which in itself comes with a cost and some effort to them. And many of them are in markets where that's not the easiest thing to do. And then they have to incrementally improve that performance over time. So once you're reporting a score, it's not good enough just to be reporting. You've got to be showing that your performance is actually improving. And EcoVadis takes that data, does the audit, feeds it directly into Taulia, the fintech front end, using an API connection. And Taulia feeds it to JP Morgan, running the supply chain finance program, and then the financial incentive is kind of automated into the process. And it's that automation piece that makes the exciting sort of part of the structure, because then of course you can offer it to loads and loads and loads of tiny companies. You're not doing something manual, you're not having to evaluate them by yourself. What's also important, I think, from the kind of ESG perspective, and obviously not wanting to distract the conversation in that direction unless that's where you want it to go, but from an ESG perspective, transparency and accountability is also very important typically to the corporates who are involved. If you're going to do the work to improve your environmental performance, you want to be able to prove that that is genuinely valuable work that is actually contributing something to a reduction in pollution, a reduction in carbon emissions, or whatever your target may be. So what the data provides and the partnership between the different parties, what that capability allows for is rigor. The structure can be tight and rigorous and well structured and transparent and accountable. And you can prove to any outside viewer that what you're doing is really making a change. And that's the exciting bit to me, because once you have those capabilities, the world's your oyster. You can come up with all kinds of interesting applications.
Thanks, Natasha. It's very clear that standardization of data really is the gateway to lots of things. And I'm very conscious that I haven't brought up the ESG or the sustainability word yet. And we are doing a whole specific Tradecast on the impact of climate change and trade. I haven't kind of forgotten about it, but I also feel that if we were to discuss this as a passing off comment, then it doesn't deserve the attention that it should get. So we are very conscious of that, and I'm not going to throw in a sustainability question into this specific Tradecast as the topic is slightly different. But actually, Brian, I think one other issue that a lot of people come across is that data sharing piece. Obviously, lots and lots of challenges there. How does this work from a data sharing perspective, and from a Finastra perspective? What are the biggest challenges you see?
So combining that data, as we've discussed previously, along with different system data and sources, is key to getting a much better understanding of what's happening. Sharing that data across platforms is an ambition, a very worthwhile ambition, and there are moves to do that. I think the standard, we mentioned the GLIEF. I think that's a very important sort of start in terms of standardization. Knowing who you're talking to has got to be one of the fundamental aspects of data. So I guess there's a couple of barriers to moving ahead, and one is a bit of a protective attitude from a lot of organizations. The data to them is an asset that they probably don't want to necessarily share entirely with other people. I think we see that changing now. I think we've seen even with amongst banks with the Trade Information Network, there's a propensity to share some data amongst each other to get much better systems and solutions out there. But I guess the big break is the threat of GDPR. It's just how far can organisations go without breaking legislation, and I think governments are beginning to see that maybe there needs to be a rethink in some aspects of the application of GDPR. Because GDPR is about trying to maintain security of data and make sure it doesn't get into the wrong hands or is made public, inadvertently, etc. And maybe there are other ways to secure that objective rather than maybe the sledgehammer of what GDPR is. So I think that's the big break that we maybe need to revisit in this context.
Thanks very much, Brian, and very conscious of time. So we're going to wrap this up with our final section, future view. So I ask you to all get your crystal balls out. And Claire, I'll start with you. And you talked about open banking earlier, so I'm going to kind of pull up that question again. What role can data play in advancing access to trade finance, and what's the opportunity within open banking?
Yeah, I mean, obviously I touched on this earlier. I think it is that democratization of data and allowing access to that data in a smart way, interoperable way, right? And we've seen good strides in the consumer space. We're veering into SMEs. I think to Brian's point is, you've got access to the data, but then you've got to do something intelligent on the top of it, right? So it's applying those tools. So I think the tools are there, the technology is there, the willingness, I think corporate appetite to open up the data. So maybe it's just the last but not insignificant piece is, thinking about kind of the regulatory side of these things like Brian was mentioning.
Thanks, Claire. And Susan, I guess more of a future kind of looking question. Are you seeing an increasing trend on certain types of kind of trade finance products as we move into, I guess, more of a riskier environment, especially as you mentioned earlier, some of the unfunded trade demands have increased, and that's a question from Azim.
Yes, well, it's an interesting moment in trade finance history. When we look back at this time, what we'll be seeing is really three forces, and it's going to be great to see how this all plays out. One, there's a little, on the one hand, there's more sort of risk skittishness, cross-border banks, cross-border investors, and even those supply chain buyers that are watching carefully on what's going on with the suppliers in their emerging markets remain concerned about the health of these firms and these banks and these economies coming out of this crisis, and while we're still enduring it. And so with that, you see a trend, there is a trend towards sort of a move to back towards some of the documentary side. And we see again this increase in demand for unfunded, which is effectively documentary trade finance. This is a great opportunity for a lot of leaders in these individual emerging market countries to expand as we move out of the crisis, which we all are looking forward to expand those offerings. At the same time, as we've talked about today, there's definitely this acceleration that's a reality in digital technology. So even with our emerging market bank network, 64% of them already at the beginning of 2020 were accelerating their solutions in the digital space. And in 2021, 74% of our emerging market bank members were asking for some form of trade finance digitization support. So we do see these great opportunities of the merging of this digital landscape, the promises that has to offer, the challenges we've discussed. At the same time, we have this moment in time where risk concerns are higher. And so it's going to be interesting to see how fast that dynamic changes. At least for the present, what I would see coming out is a bit of a hybrid there, where we're moving the digital piece to cover what was once documentary and expediting that, but we're still treating that as a bit of a risk factor. It's over the long run or medium run that these benefits are going to convey. And frankly, I think that makes for some very positive outcomes in terms of not just trade finance, but in terms of trade. As trust increases, as the marginal cost of each trade transaction decreases, then that actually is a shape-shifting move for the development evolution of trade itself, which ultimately drives growth in many of these countries. In short, again, our client banks, we've seen the annual outlook that we look at every year for trade and trade finance from our emerging market banking perspective. 50% of our banks had a negative outlook in 2020, and now 73% of the banks that we surveyed have a positive outlook in 2021. So just like the IFC and those of us on the call, they believe in the future of trade and trade finance as well. We're looking for a positive slope change overall in the development trajectory of many of these countries. And my personal view is it's going to be led by trade. That's why I come to work every day.
Thanks, Susan. A very positive view there. Brian, I'm going to end this panel discussion with I guess more of an open question. What's your future-looking view on digital trade, and what do we need to see happening to move forward?
So the impetus is here. I mean, it's driven. COVID has opened the doors really to digitization as a necessity. It's opened the eyes of governments as well. I think we see the G7 now pushing for digitization. So because the prize is huge for everybody, you know, it's financial inclusion for social good, of course, SME financing, absolutely crucial to any economy. So it's absolutely, the impetus is there and it's moving forward. I don't think there will be a two-tier system through digitization. I think there'll be a role for small banks, and increasingly so. And also, and we haven't really touched on this, a role for non-banks. Increasingly, we're seeing that non-banks are, you know, getting involved in financing. We ourselves are launching a platform along with the ICC to involve non-banks in financing called Tradecom. So that is an area that I think will grow in terms of filling the gaps that maybe banks don't or can't fill necessarily at the moment. I think just looking ahead in terms of digitization, if we take it even further, I see and we see that you know, trade as a service, like banking as a service, will become more and more embedded within supply chain. So it'll be more easier for organizations to get access to that level of finance quickly, as and when they're doing business, rather than going off on a parallel stream to seek finance. So that ultimately, I think, is what the customers, our customers and the customers of banks would really like to see. Just have that ability to have that finance as and when they need it, with the minimum of pain to go through the process of getting that finance.
Thank you very much, Brian, and I'd like to thank the panel once again for joining us on this brilliant Tradecast. I think I would like to conclude by just making a few points here, really, and I think, you know, the pandemic has forced us to rethink trade and trade finance, as well as its digitalization in ways we've kind of never really thought about before. But I think what's been really resonant across the whole panel is really thinking about financial inclusion, MSME access to finance for women-owned businesses, and also those smaller businesses in emerging and developing economies. I think as we move forward, we will definitely see an increasing role for smaller banks and non-bank financial institutions. And it seems like the outlook for trade is fairly positive moving forward. And I think technology really is there to help reduce the risk, reduce the cost of finance, but also look at SME risk in a completely and credit risk in a completely different perspective. I think we'll definitely see the increase in trade and trade finance as a service. So I'm sure that will be an upcoming theme over the coming years. And we'll also see the evolving of supply chain finance. But I think standardization of data, standardization of trade finance data fields, etc., really is key to moving things forward there. So once again, I'd like to thank Brian Edmondson at Finastra, Susan Starnes at IFC, Natasha Condon at JP Morgan, and Claire Thompson at MasterCard, as well as Finastra, our main sponsors for the Supply Chain 4.0 Optimizing the Chain Tradecast. This Tradecast will be available on demand on tradefinanceglobal.com/Tradecast. And our next Tradecast, which we'll be talking about and providing details shortly, will be in and during COP26 in November with the ICC United Kingdom and the ITFA. Thank you very much for joining. It's been a pleasure.